Good morning, traders. Welcome to the Flow Show. So just keeping an eye on what's going on. Seems like yen pairs are dropping at the moment, and that's dragging a few others with it as well. Just keeping an eye on what's going on there. Anyway, just me today, as came in off for an appointment. So he's picked a day because there's not a lot to talk about from yesterday. Considering it was US holiday, Canadian holiday. Not a lot going on, but I've pulled out some bits and bobs to discuss anyway. Going to start off in Japan, where Chief Cabinet Secretary Hayashi said they're going to use 982 billion yen reserves for power and gas subsidies. These were the things that they've had in place for quite some time as the cost of those things, energy and whatnot, have gone up. They're going to continue subsidising that and dip into their yen reserves for that, it seems. There was a 10-year bond auction in Japan, JGB auction, which mainly looking at just to see what the take-up was like. And there was a decent bid to cover of 3.71% versus 2.975%. So as yields have been creeping higher, there's been a bit more appetite to take up these bonds, which is good news for the government in one sense, but it also has people thinking that they're finally going to get some decent yield out of the market there as well. So we could be seeing maybe a couple of whales dipping in as well to pick up some of those bonds. Over in the data, Switzerland had some GDP data out and some CPI data out. GDP first coming in okay, beating expectations on the quarter for Q2, 0.7%, year on year coming in higher as well. CPI, that came in softer than expected, was expected to come in up a pip on the month, came in flat. And came in softer as well on the year on year. So if the S&P do have in mind another cut, and this is their month when they've got a meeting to do so, they have quarterly meetings, then that could be a green light for them to cut rates again. Riksbank, they seem to be well into cut mode. Riksbank's Theden says 3 additional cuts more likely than 2 this year. They're already on their cut path. He says the economy is sluggish, but the outlook is positive. The best guess on where the neutral rate is around 2.5%. So it looks like further cuts are coming, and maybe more than we expected from Sweden. Germany retail sales data out. I don't know if it's on this calendar. Let's have a look. No, it's not on this calendar out. So retail sales came in year on year. This might have been a revision actually, because it's May data apparently. Came in minus 1.1% versus minus 0.7% expected. So those sales there, I'll have to check that out, because that may say May data, but it might be a misprint or something. Anyway, over to the ECB, and there's been a couple of pieces out from both Reuters and Bloomberg circling around the same thing, really, saying that rate cut decisions are going to get trickier for ECB members. One, as inflation keeps coming down, and 2, as the interest rate approaches 3%. There's going to be a bit of a bum fight, apparently, between those who want to who don't want disinflation to disappear, i.e. stop cutting and to keep inflation falling. And then there's going to be others who want to be worried about the state of the economy, possible recessions, so they want further cuts to come. So if, as the rule of thumb, or as the economic textbooks will tell you, the lower interest rates come down, the more pressure it might pile or bring on inflation. So there's going to be a trade-off between keeping inflation falling and making sure that growth doesn't fall off a cliff. At the moment, it's all flatlining. So apparently 3% on interest rates is the benchmark where arguments will begin, when isn't there an argument at the ECB. So good news, potentially good news for the UK. This British retail sales monitor for August came in at 0.8%, suggesting that there's been a late summer splurge from UK consumers, meaning that we potentially will see a decent number or an upbeat number at the August main retail sales report, which is to come in a couple of weeks. Over in geopolitics, we've had Biden saying that they're very close, Israel's very close to a final hostage deal. And there's been a Hamas official saying the group will respond positively to a proposal that can secure a permanent Gaza ceasefire and full withdrawal. We've heard lots of headlines that a deal has been close, but Hamas has pretty much thrown that out the water or out the window, saying that it's not close and they've not agreed anything. So maybe we are, maybe we're not. We still have the possible threat of an Iranian retaliation for what went on with those guys in Israel, and they might be waiting for this deal to be secured, and then we might see something from them. So that risk hasn't gone away. That's about it I've got on the headline front. It was a pretty quiet day yesterday. Not a lot going on there at all. Let's have a look. Anyone in the chat today? Not seen anything. Let me just make sure it's working. Oh, yeah, it's working. Everyone's silent today. Ah, there we go. There you all are, working fine. You're all half asleep, are you guys? I wonder what was going on. There was nothing in the chat for a minute. Right, so what's coming up today? Pretty much the big news is going to be the ISM PMI from the US. Lots of eyeballs on that. And I want to bring this up because this was one of the data points last month that mixed in with the NFP, got the dollar all thrown out the window. We saw that big move down in the dollar. And one of the components was this, the employment component, which dropped to a very unhealthy 43.4. Now, just for a bit of context, and I've made this point before, this number hasn't been in the positive territory for quite some time. We've had one expansion number in the last 11 months. As you can see there, it was back in October 2023 when we had what looks like a bit of a blip into expansion. So this employment number has been in contraction pretty much for the last year or so, if not longer, with very few positive numbers. The fact that this was a bit of a stinker, okay, that's granted. It dropped pretty much 6 pips from 49 to 43. So it was a big drop, I'll give it that. But it's not as if we just suddenly went from expansion to a big contraction. So a bit of context there. A negative number here again today might not be as negative as it seems, obviously, depending on what it is. If it drops to 38 or something, then the market will probably throw its toys out the pram yet again. But the trend is what you need to look at, and it's been negative for a long time. We know manufacturing's been in the doldrums for a long time, so it wouldn't be a surprise to see another bad number here. Of course, what the market makes of it is anyone's guess. It made a big deal of it last month. You can't rule out that it makes another big deal of it this month. But as I say, manufacturing hasn't exactly been the booming sector for quite some time now. So, the surprise would be if it's good news rather than bad news. But we're chasing the size of Fed cuts at the moment. So that's the game we're playing. If it is another bad one, we're going to see pricing stepping up, probably for 50 BP cuts as well. The rest of the numbers, they're all pretty much in contraction except for the prices paid. So this is, again, is probably one you want to keep an eye on too. If that falls into contraction, that's really going to, again, cement those rate cuts from the Fed, because that will show more disinflation coming into the number there. Let's have a quick look at how it's been trending. So as you can see, it's not really trending that much lower. We've only had a few months after coming off this high of coming down. So we're still very much in expansionary territory. So again, keep an eye on that one too. That gives us our data pretty much for today. We've got a couple of auctions later on, 3-month, 6-month auctions, but that will be looking much from those. So that's going to be the data to keep an eye on, and you need to bear in mind that we're going to be swinging from data point to data point all the way through to the Fed. So you're going to see a reaction in this data and then get a good one, and you get a counter reaction. So you can't pick one data point, whether it's good or bad, and say, right, that's a decision made for the Fed. You know, we could have a bad one here and then get to the services ISM and get a good one there. And any dollar selling you've seen on the manufacturing reverses on the services, and vice versa. So don't get tied down to any particular moves, watch your ranges, and so on and so forth. So as mentioned, I don't know why the yen is under the cosh this morning. There was a piece out overnight about you either presenting a paper to some government bods that the conditions are still okay to continue with hiking. I've read the piece. It's a bit flaky. It's not really anything we don't already know. If the outlook remains the same, they're going to or conforms to forecasts and whatnot, then they're going to continue hiking. You know, that's what we already knew. But the market, it seems, decided to buy some yen on the back of it. I don't know what this last drop is all about. Haven't seen any headlines thus far. As I said, we're getting a little bit of a drag down in some of the crosses, and that's putting a bit of a kibosh on some of the majors as well. Euro dollar, that one it's made a new low. It's tickled this fib, had a little look under. We've been sitting in this range from this fib up to the 70s. Hasn't really done much, obviously. Yesterday, nothing going on. It's had this little move, so it's keeping, even though we just nicked under and we're trying to get back above. It's the fact it's made a new low just keeps all this move off of 112 going. But I'm not going to take too many clues from this. As I said, with all the data coming up, bad number, and we could be up above 111 just as quickly. But in the meantime, this is about managing positions you got on. If I see a proper break under here before we get to the data, I'm going to look to take a bit more off my short. I suspect the path of least resistance at the moment is lower because we got all this stickiness, 110, 70s, 80s, 90s, all that up to the big figure. It looks a bit clearer below that if we do get a break, we're going to be in the low 110s not too long after. But I'm not expecting an outright collapse all the way down to through 110, all the way down to 109, anything like that. Just think we might just get a little bit of a move down to some of these levels down here. But as I said, can't get too tied up in it. If we get a good manufacturing PMI, then that might give it the kick lower, but we shall see. So if we get a move under, I'm going to take a bit more from my short, but otherwise I'm just looking to see where we range to. Euro sterling, or staying on that boat, was starting to really show a bit of a shallow uptrend, but it's small beans at the moment. The fact we are making higher lows and just about higher highs suggests that this support is solidifying down here. But as you can see, we've come back down a bit, so we're not out the woods on this one. We've played this game so many times. When we were down here last time, came down, we had breaks under, then we tried to creep up and we came back down and up and down and up and down. So until we start to see a move that builds either on this area as support, then we may get a push up like we did here. We tried the upside, came down, then we held it as support, and then we got that move. Or perhaps we have a test of the downside, get through that 83.80s area. I have been getting the itch, as I mentioned, to maybe go with some sell stops through 83.80 if this support continues building. I'll just stick some sell stops in there for just in case moment. Kiwi broke under the 62.15 area, this area I was watching, and we're now just trying to get below the bottom of this zone, which is around 95s. If we do that, that's really, we might be going back into the box, and we're going to see this area solidify once again. This area has been pretty much in play for most of the year, as you can see. So a move back down will make this look a bit of a fake out. and yeah, well, then we're heading back into maybe playing this range once again. Pretty tight range, to be honest. I'm out of my shorts now. My trailer got knocked out on the way back down in this move, so it was a nice run off of the 60 level. All things come to an end, and always got to protect the money behind. So trading stops always the way forward. So yeah, don't know what's going to happen this one again. We're at the mercy of the data, and that's the overriding feeling I've got trading this week and today. You know, everything's a bit wait and see. You know, what are we going to do with this data point? What are we going to do with that data point? And it's going to be a case of reacting rather than picking a side. If we didn't have all that, then I'll be thinking maybe try a short now we're below this area. But I can't, because I haven't got the conviction, because as I say, big US data, and it could move either way. We could be back at 63s as easy as we could be down to 61s. So it's really is a bit of a coin toss. Aussie Kiwi. I'm still kicking myself a bit of this one. We went back last week to the old magnet level. Pretty amazing, this pair, how often we come back to this bloody 108 level. We've had a bounce off of it. The Aussie has been a little bit weaker than the Kiwi. And again, I said it last week, the market really not buying the RBA's bullshit that hikes are still on the table or a possibility. And that's one reason why the Aussie's been turning. There's the data that's been out recently isn't the greatest. There's signs of cracks appearing in the economy. And that's probably something that the RBA are going to have to acknowledge at their next meeting, irrespective of what inflation's doing. But these clowns like to talk out their asses, particularly, you know, they weren't supposed to be hiking until this year. And here we are still talking about cuts. So that tells you what their forecasting is like. Anyway, we've had a bounce off this 108 level. It is the magnet. So we might be playing this same game again. We're going to be up, trying and testing the levels all over again to see if we get another move up. So if you were short up here, good play, well done. You certainly made your money out of that one. I may look to do that again. I'm more interested in just playing the moves either side of the 108 when it gets to reasonably significant stretch points and levels like we did up here, like we did down here. So I'm going to leave it be and see if we get another move either side of the range. Dollar CAD, not. You might say it might be following oil a little bit now. It's looking a bit similar. We had a big drop in oil, and you know that's still looking weak there. So maybe we're seeing a bit of you know, CAD weakness as well. But it's been on and off the oil bus at the moment. I've nearly been stopped out of my shorts. My trailer's currently at 135.35 from that move from 135.80. I think I'm more likely to get stopped than not at the moment, the way this is looking. Just coming in a bit closer. This is a really old trend line going back to 2021. I'll just show you quickly. It's not something I'm really focusing on, but it's there, so I'm keeping half an eye on it in terms of what the market does. I'm more interested in what happens if we get back up to this zone, up to the 135.80, 136 zone, because that was the big break point. If we find resistance into that, I might keep an eye on that to re-enter a short depending after the data. So I'd like to get all the data out the way and see where we are before deciding on trading this one. But with oil down among recent lows, there is the possibility that we just range play here and maybe we see a bit of a bounce like we've done previously down in this sort of 71, 72, 73 area. And if we do get a bounce there, then maybe the CAD will follow. But the BOC is Wednesday, expected to cut 25 pips. The question is really going to be, are they done or are they going to look to continue? And that will decide the fortunes of dollar CAD or CAD in general. Now I mentioned the Riksbank, we have seen a bit of weakening this morning on the back of those comments. Just shows that even though the market knows which way a central bank is going, if that central bank increases the possibility of more rate hikes, bigger rate hikes or anything, we can still get a reaction in the currency. Not a huge reaction because the market's already going that way, but it's just a bit of additional info there that we get. Let's go on one with some tech on it. Not that I look at this an awful lot, but keeping the tech pretty simple, you can see where the main support is. We tend to hold a bit of support into this old 38.2 fib around 1020s, but we've also got that secondary area 1014. So a bit of a range play potentially. Longs off here, short up there, and see if you hold the range and stay in play. Again, this might be another one that we get a test of this downside area depending on what the US does. But if we test and hold there, this may be something to keep an eye on. If we don't break below this level, might be worth looking at from the long side on that one. Gav, yeah, it's all intraday stuff. I'm not really doing an awful lot at the moment. Not even the sniper rifles hanging on the wall at the moment. This is when you get these big data weeks, and you sometimes you just don't know what's going to happen. So you can't. It's hard to pick a side. It's hard to say, I think this pair's going this way and this pair's going that way, because you just don't know. All you can do is keep in the back of your mind where we're heading. And where we're heading is, if we talk about the US, we're potentially heading for a cut in September. So everything that we trade from now until the FOMC is about, A, is the cut valid or not? And B, is the cut going to be bigger than 25 pips or not? I think still that any data points or news or central bank speakers or whatever that tilt expectations of the market pricing towards 50 basis points, I think is a bit of a fade trade, because I don't think they're going to go 50. But as I mentioned in the room, I'm going to reserve some of the judgment on that depending on the NFP. If we see unemployment at 4.6% and a minus 200 NFP, then the market will go potty for a 50 pip hike, and it may be more justified depending on how the Fed view it. So I would see the risk greater that they go something bigger like that. But if we don't, if the NFP's, even if it's the same as last month, that won't be a disaster. And I don't think that 50 basis point cuts will be justified. So that's the sort of thing I'm looking at the moment. If we get any extreme pricing for the Fed during this week, that's maybe where I'll start trying some little fade trades, a bit of scalping off the levels. Treading water is a big theme mentioned in the room earlier. We've got a couple of assets doing just that. Gold is one of them. Former highs, 2380s. That's really where your marker is. You might want to include that little spike down to 70s. But as you can see, we're holding above that 80 level anyway. Clear as day, 2530s is your high point up there. So you can take your clues. There's enough here to trade the range if you want to do that. As I say, if you see a data point and we test and can't get through, then you can probably have a look at maybe a bit of a range play. Break trades, there's a few that are lining up. I've mentioned euro sterling, a breakdown through 83.80. Gold, you may want to think about a break trade up through these highs here, but depends how that high break is driven. If it's driven on a data point, I'd be careful, because as I say, you might get a reversal. So you've just got to be careful. You want to maybe look, if you're going to look for trading breaks, wait for a confirmation. If it breaks, comes down, tests and holds, that will be the signal to maybe try it, and you can try it with a really tight stop. If it doesn't happen or doesn't carry on going up, then you haven't risked a lot to do that. Stocks, the same. Again, if it wasn't for what's going on this week, I will be, let's take away that box for the moment. If it wasn't for what's going on this week, I would be thinking about a buy stop through here. because we had the high, we had a pretty decent pullback, to be honest. It's quite large, and we're back up here, but we're struggling up here. We are just sort of edging high, so we are looking to test it. It's looking like it wants to go and it wants to blow. And in that scenario, I am thinking closely about a buy stop. But again, it depends on what causes it to break and whether I'm happy with it causing it to break. If we didn't have all this data and crap going on, if this was purely just on the technicals, I'll be sitting a buy stop here, maybe 56.80, something like that, looking for a break. But what I don't want to happen is stick a buy stop here, we go 5 pips through it, and then reverse all the way back down again and get stopped out. It's just no conviction. So if we come through this week, all the data, and we haven't broke it, but we're not pulling back too far, then I'm going to be, I think, jumping in with some buy stops just to see. Now, the reason I had that box up, I think if you don't want to get involved in all the noise in here, then this is really your range. These are the levels you've got to look at. Obviously, the highs, and then down around this 55, 60 area. If we're back below there, then we've got the possibility of dropping further. So this is your really, if you want to just get 2 levels to look at, 55, 55 and up towards these highs, and take your cues if we move out of either side of those. Obviously, another move on the downside, the real big level down here is this 54.5, which was a level on the way up, on the way down. Then we had a bit of wish-wash, but as you can see, just in now, we've got times where it held and then broke, held and then broke, and then here we go, break, hold, and off we go again. So it is a key pivot level, this one. So if you're shorting up here, this is one level you need to respect, either for taking a bit off the table or for those who want to go long or flip it to a long. This is your key level. So judge your trades. Anything that happens here, judge your trades on this one if we get there. If it drops to there, holds, then that does keep the upside in play, and maybe then go on to break it. Obviously, keep an eye on yields today as well. 1 second. Excuse me. They're not doing an awful lot at the moment. If we look at some of the short end 2-year yields, we've still got this pretty tight range, 380s up into 412s. Again, if you're trading the dollar, watch these yields, because unless we're breaking out either side of this range, it's going to likely cement some of the ranges we're seeing in FX as well. But if we do get a breakout of these sort of yields, again, look to see if it's a fake out like this move, or if it's something more solid. So this move here was that prior NFP and all that stuff that we got last month, where the market really fell out its pram and then recovered. And as you can see, we're just holding. We've got a bit of a range play going on here. So keep a yield chart up as you're watching the data today, and just, as I say, take your cues from that one. Right, any of you boys and girls got anything you want to have a look at? So not an awful lot going on. We're all sitting, watching and waiting for the next big bit of data. But if you've got something explicitly you want me to have a look at, then just throw it up in the chat. Dollar MEX, have a quick look at that one. We're back up towards these 20 highs. Bit of a level here. Against this fib 1990, which has been a bit of a level all on its own, as you can see back there. If we do get a move up back into the 20s, then we could be off to the races again, and a move up to this 50 fib in the 21s will be on the cards. This will likely mean, I think if we get another break of this level, we're going to see even more of the carry traders chucking it out, because then you're getting into the territory where the carry traders back in 2021, 2022, they've been shorting up here. Now they're getting their trades put under pressure with a move into 20s. So we could get a little bit of a knock-on effect again, a little bit of a domino fall, domino rally. Remember that old game? Domino rally kicking off here, and we get even more of the carry traders getting out. But definitely above this 50 fib, then I think we're going to see potentially the end of the carry trade for a lot of people as things move back to normal. Right, well, if you boys and girls have got nothing else to talk about, I've certainly got nothing else to talk about. So we'll call it a day for today. Keep an eye on that data, trade carefully, know the numbers that are important. That employment number is going to be important. That prices paid number is going to be important. Judge it in the context, watch what the market wants to do with it, and trade accordingly. Have a great day, have a safe day, and we'll review everything that happened tomorrow. Have a good one.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.